Hey, welcome back. Today we're going to be talking about how do real estate investors get paid. So are you interested in investing in real estate, or perhaps you already are, and you want to look at what are all the different ways that you can get paid as an active real estate investor? Well, in today's video, we're going to take a look at all of the different ways, including the different profit centers in a real estate deal, management fees, deal initiation fees, profiting from doing joint ventures, all sorts of things. That's what we're talking about here today. All right, so the first thing we want to take a look at when it comes to profiting from real estate investing are the different profit centers in a deal. Now, depending on what kind of real estate investing you're doing, that's going to determine how many profit centers you're going to benefit from. But there are up to 8 different ways that you and I, as active real estate investors, can make money on a deal. I'm going to try to remember them all. I'm not sure if I can hit all of them, but the ones that come to mind first are instant equity. So that is when you buy a property, you get a deal on it, you get it at a discount. You're creating instant equity. Next thing would be cash flow. So the net profit you're making at the end of the month from a real estate deal. Another one would be market appreciation, the natural value increase in a property over time. Another one could be forced appreciation. So if you're doing some renovations, some repairs on the property, and you're increasing the value of the property up and beyond what you paid for it, up and beyond what you put into it for those renos, that's forced appreciation. Then you've got mortgage pay down. So every month that your tenants are paying the rent and you're paying down your mortgage, well, they're actually paying down your mortgage, you're creating more equity in that property. Another one would be depreciation, which is a tax deferral situation where you can put off paying your taxes for a while. Not really a profit center, but it keeps more money in your pocket short term. Another one would be basically reinvestment. So taking your profits from one deal and instead of spending it all, reinvesting in another property. Or in the States, you can do 1031 exchanges. Another good one is leverage. So that's because you're able to get into a property with as little as 10, 20% down, and the banks will finance the rest. So you own the entire thing, but you don't have to put up very much money, and the bank puts up the rest. So these are just some of the profit centers that you can benefit from as an active real estate investor. Now, another way that a lot of people get started with profiting from real estate investing, especially in the early days when they're just getting going, is by actually finding deals and then passing them on to a different investor. So why would you do that? Well, if you're really tight for cash, if you don't have that many contacts, if you don't know really what you're doing with real estate investing, this is a good way to get started and start making some money without actually having to invest yourself. So one example is being a bird dog. What's a bird dog? A bird dog is somebody who goes out and finds distressed looking properties and passes those on to an active real estate investor for a small fee. So they're not sure if they're going to turn that property into a deal or not, but you go out and you scour different neighborhoods and you find properties that look like good prospects. You bring them to that person and they pay you a fee for that. So that's bird dogging. Another one is wholesaling. So this is a little bit more involved. That means that you actually go out and you find the deals and you tie up the deal and you negotiate the price, usually at a very low rate, a very low price property or a really good deal on a property. And then you go and you sell the opportunity, you sell the deal to an active real estate investor. So a lot of wholesalers are finding these smoking deals and then they're selling it to an active investor who's going to flip that property. And then they make a $5,000 or $10,000 fee for finding the deal and passing it on. So those are a couple of ways that you can make money in real estate without having to actually buy the property. Another clever way I've seen people get paid in real estate investing is by charging a deal initiation fee. So what does that mean? When you find a deal and you bring on a joint venture partner or you bring on investors to finance that deal, I've seen different people actually charge a fee for just getting the deal started. So one gentleman I knew years ago, every time he'd find a single family home type deal, whether that was a BRRRR or a flip or whatever he was doing or just buy and hold, and he brought on a joint venture partner, part of the deal was the joint venture partner would be paying him $5,000 for finding that deal and getting it all going. Now he explained it to the joint venture partner, hey, you know what? We're going to be doing this deal. I'm finding the deal. We're finding a great smoking opportunity, and we're both going to be making a lot of money long term on this property. However, the cash flow is probably only a few $100s a month. So that's not going to keep the lights on. So I charge this deal initiation fee in order to pay myself a decent salary to be able to go out and find you more deals. Now, here's the cool thing. The investor or the joint venture partner is actually covered long term with this because that's part of their initial investment. So for example, if they needed $100,000 for the down payment, closing costs, renovations, all that kind of stuff, then this gentleman, he would raise $105,000. $5,000 would go to his deal finder fee. The other $100,000 would go right into the deal. But at the end of the day, at the end of the 5 years or 10 years or whenever they're going to refinance or cash out, the investor would get their initial $105,000 out of the deal first before they split the rest of the profits. Does that make sense? So that way they're both covered. You as the active investor, you're getting some income today, as well as the different profit centers you're going to be sharing with your joint venture partner. Plus, it's a way that your joint venture partner is covered in the long term. Does that make sense? So that's another way, is you can just charge an upfront fee for finding a deal. Another way that real estate investors get paid is if you are managing the deal for your investors or your joint venture partners. So this is usually for bigger deals like apartment buildings or self-storage facilities or mobile home parks, where you as the manager charge the management fee. Why? Because if you are hiring a professional property manager, you would be paying them somewhere between 4 and 10% of gross rents as a fee for doing that management. So if you're doing all the management, why wouldn't you charge you and your investor partners that fee as well? So that's another way that you can get paid. Another way that you can get paid as a real estate investor is by bringing on joint venture partners or bringing on private capital for your deals. So how are you getting paid that way? Well, you're getting paid very, very well because basically you're able to grow your portfolio without using any of your own money. This is huge. This is massive leverage. You're finding the deal, you've got the team, you've got the experience, you're bringing on investor partners or joint venture partners who are bringing in their capital and their credit to do the deal, and then you're sharing in that property. So whatever profit share that you've got, if it's a 50-50 on a smaller deal, or maybe it's a little bit more skewed in the favor of the investor on bigger deals, but you are still profiting from all of the different profit centers on that deal without any of your money in it. So that is a huge way that active real estate investors get paid. Another way that real estate investors get paid, especially when they're getting into bigger deals, is with syndications. Now, syndications, you typically get paid a couple of different ways. One way is it's kind of a combination. You get paid with some equity in the property, so you're getting some of the ownership in that whole deal. But typically, syndicators are also charging a fee for setting everything up, and that varies all across the board, but quite often I've seen where it's up to 4% of the total capital brought into the deal, or in some cases 4% of the total value of the deal is what they charge their investors as a fee for bringing the whole thing together. So this is kind of like a version of that previous one I told you about, that deal initiation fee for smaller deals, but this is on a much bigger scale. Because imagine if you're doing something like this on a $100 million property and the fee is 4%, well, that is $4 million. That starts to add up pretty quickly. But again, that's on much larger syndication type deals, typically with a lot of different people that are involved and a lot of different folks that you have to share that fee with as well. But that's another way that real estate investors get paid, especially when you're starting to scale things up. All right, speaking of scaling things up, if you are ready to start bringing on joint venture partners or bringing on investors and you don't have a lot of experience with that yet, I've got the perfect resource for you. It's my book. It's called Money Partner Formula. And this is the perfect way, it's a proven way for you to raise your first or your next 6 figures in a matter of weeks and even 7 figures in a matter of months. I'm going to put the link in the description below, or you can go to my website, investorattractionbook.com, to get your copy. And this is a great way for you to start doing more deals, bigger deals, and to really scale your portfolio so that you, as a real estate investor, can make a lot more money.